Here, look at this. Third property like it in the last 4 months. I take you inside, but the seller's on a 2-week lease back. But no banks involved, 11% down, and 0% interest. And the sellers, they were happy with the price too. I mean, what are the chances? Better than you think, if you know what you're doing. So I started seller financing to build my cash flowing empire about 17 years ago. And it was an absolute game changer for me after I filed bankruptcy in 2001 when my record label went belly up. And I was something that the banks called unlendable. You know, I probably would have been lucky if Wells Fargo even let me in the door at that time. A lot has changed for me since then. More assets, more money, my credit score, it's back up above 700. But what hasn't changed for me is my preference for seller finance. Regardless of how high interest rates go, sellers will always do better. So if interest rates, they got you bummed, and banks, they want too much of a down payment, and sellers, if they want too much for their property, I'll show you how I structured this deal with 11% down and 0% interest. Jerome, jack up the rates Powell, he's definitely gonna be scratching his head on this one. You ready? Let's go. Imagine this, you find a great income property, but instead of going through the usual bank loan process, you strike a deal directly with the seller and bypass the clumsy loan process altogether. No credit check, no appraisal, no contingency. That's seller financing. And with it, I get to skip all of that stuff. Seller financing empowers me to pay the seller in affordable installments, just like a mortgage, but without all the red tape and paperwork. I think of it like buying a house with an IOU to the seller. Now, I know what you might be thinking. You can buy a house with an IOU? How is that even possible? Or maybe you've tried this before, but the seller always seems to say no. Well, that was my experience too, for a long time. And here's what I learned that allowed me to start hearing more yeses and doing several of these a year. Mistake number one that would get in my way, I would bring up seller financing too quickly and I scared them. Or two, I made it too complicated and I confused them. Or three, they needed all of their money for something else and I just didn't hear it. I ignored them. When I stopped making these three mistakes, I saw a noticeable increase in the number of seller finance deals I got across the finish line, like 3-to-1. It was significant. One other shift in my mindset I had to make, and that was to recognize how seller financing benefits both parties. It benefits the seller more than most people think, and it just takes a minute for most sellers to understand how. You just got to break it down to them. But once they see that they can get more money, steady cash flow, some nifty tax benefits, no agent commissions, no appraisal needed, no lengthy escrow period, a significantly simplified process, and that they are secured by a tangible asset, the right sellers are down. And as a buyer, many of those benefits are my benefits too. Not to mention I get easier qualification and flexible terms. And you know how much both parties save by removing the man from the equation? Enough to make it worth it for buyers and sellers to play nice together. Now there are different types of seller finance deals, the most common being either a land contract, a lease purchase, or a mortgage note. And there are some nuances to each of them, but they all really boil down to me giving the seller some money now and then giving them the rest later. How much now and how much later depends on what I negotiate with the seller. And that's where the structuring of a seller finance deal begins, with the negotiation and proposal of price and terms. And that's how I buy real estate, by either my price and the seller's terms or my terms and the seller's price. I only need control of one or the other to put a good deal together. Let me show you with this. It's my deal dynamics axis, TM. The vertical line represents the price I'll pay for the property, and the horizontal line represents how I'll pay the price. It's almost a given that the seller wants all their money now, the how. So that leaves me with how much money I'll give them. And for a deal to make sense financially, it leaves me no real choice but to start down here with the super low price. And as you can imagine, sellers typically don't like that price, and so they ask for more. Now, instead of going back and forth over the price, like most investors do, I will typically and reluctantly agree to the seller's price, and I'll ask for more time to pay it. I found that I'm much more inclined to get a seller finance deal done when proposing it in this order. It's like a first date. I don't greet him at the door with a big sloppy French kiss. I wait a bit until at least after dessert, right? If I go straight in asking for seller financing, I get shut down much more often. So I marinate on the price for a bit, because that's really the only thing most sellers understand anyway. And if I reach an impasse there, I then introduce the terms, but not how you might think. You see, when it comes to structuring a seller finance deal, there are 3 sets of terms that I incorporate to complete the structure. The first set are the terms of the sale. And it's either going to be a low price with a single installment or a higher price with multiple installments. Then next, I've got terms of the loan. And here's where I'll negotiate how the installments will be paid. And here I've got options. I've got lots of options here. Then I've got terms of the documents. And most investors, they miss this one because they think the deal is over. There's a deal after the deal that nobody ever told them about until now. I did an entire breakdown of the deal after the deal in this video right here. And I'll put a link in the description too. And I'll even give you my documents in that video, but only if you click the like button on this one. So this deal right here, I found it using Deal Engineer's AI predictive analytics. Sent them a handwritten letter using a new QR code strategy I'm testing. The seller called me within a week of me sending the letter. I used my 9-point seller interview to get the information that I needed and built some rapport with the seller. And they weren't too excited about what I proposed, but they asked me to follow up in a month, which typically means thanks, but no thanks. And when I got back to the office, I put them in my Green Apple follow-up system, which immediately sends them a triple offer letter. In this letter, the first offer is the deeply discounted fast cash offer. That's right here. The second offer is my wholesale priced 90-day offer here. And the third offer was full market value of 5% down and the balance divided into 300 equal monthly payments, 0 interest. It's simple. I just recap in the letter the different price and terms that we discussed when they told me they wanted to think about it. The seller called me about a week after that, and long story short, they wanted 15% down instead of 5%. We settled at 11%, and we wrote it up like this. This is just a standard purchase agreement, but with a few additional clauses that preps us to move forward with regardless of which offer they wanted. They're not necessary clauses, but they streamline the process. And I structured it like this. The price goes here, just like it would on any other purchase agreement, and then the terms in here. And I just write them out as I and the seller understand them. There's no need for any complicated legalese here. It's 11% down, balance to be divided into 300 equal monthly payments. So we both signed. I turned it into the escrow officer along with my promissory note. Now, this is important if you want to take advantage of the deal after the deal I was talking about, the terms of the document. And it can be a deep rabbit hole that I don't want to go down now, but I did put the link to that video in the description if you want to check it out. Now from here, everything happens in the same way it would with any other deal. I ordered a physical inspection, escrow ordered title, and once everything checked out, I brought in the down payment, we both paid our closing costs, and I handed the seller finance mortgage over to a third-party note servicing company who's responsible for the collections and the accounting of the mortgage. My LLC is on title to the property. The seller has a loan attached to the property for collateral, exactly like a bank would do. The only difference between this deal now and any other traditional transaction is instead of sending payments to the bank, I send them to the servicing company. And the servicing company deducts 1% and sends the rest to the seller. And that is how I structured this seller finance deal with 0% interest. It really opens up new avenues, even if you do have access to traditional financing. Besides, it's just better paying a seller directly than a bank. Banks make enough money. So let's keep it in the family. That's my motto. If you want some additional help with this, there's a link for that in the description too. Or just hit the subscribe button. I'll be back in a few days with more. Cheers, peace, and blessings. God loves you, and so do I. Take care.